So let's move to valuation, because I know that's kind of your, I know that's your strength and what you spend a lot of time in.
Sure.
Let's talk, if you can just kind of, before we dig really into the weeds, give us an overview of what you think the impact of the pandemic was on valuation. If there are a couple of key elements of what moved in that valuation world.
There really are some pretty significant changes that have occurred. Maybe best to start with a quick primer on valuation. We typically look at a company through three lenses: what we call the income, the market, and the cost approach. On an income approach, we're really looking at the future cash flow generating capacity of the business. So this is revenue minus expenses minus other things that you have to do to reinvest in your business and capital expenditures. But what's the bottom line cash flow that's going to be available to the investors in the company, and what's the risk of achieving that cash flow? Okay, and on that income approach, we have two primary methods. One is just taking a look at the most recent year and capitalizing it, or putting a multiple on it. That's a risk-adjusted multiple. Okay, so if we say cash flow that is available to the equity holders is $1 million, and we say that there's a 10 cap on that, then we would say the value of the business is a 10 times cash flow, or a $10 million valuation on the equity of that business. That method of capitalizing cash flow presumes that future cash flows are stable at this $1 million level, okay, or steadily growing at a predictable rate. And that, in many cases, in a normal economy, may be the case for a lot of businesses. In the COVID economy, that really shifts, right? And we take a look at temporary severe downturns to financial performance for a given company, with an expected ultimate rebound of that performance at some point, hopefully to normal levels, okay? Or for some companies, it may be exactly opposite, an extreme upside, because they happen to be, we'll call them COVID-proof type of companies. They may have a significant upside, but then they will expect to trend back down as their competitors are able to regain their footholds. Both of those types of scenarios really require the appraiser to look at a detailed financial forecast of that cash flow. What is the impact on that cash flow over time, and how long does it take to stabilize back to a new normal level? That method on the income approach is what we call a discounted cash flow model. And so from an appraiser's perspective, a very material change is where we may have just simply needed to ask for historical financials and use those historical financials to develop a capitalization of benefits method. Now we really need to work with management to develop a financial forecast and present value that future forecast back to today's value. It's a very distinctly different exercise for an appraiser to go through, particularly when financial forecasting is so difficult in this environment. So it really requires the appraiser to work with management very closely to understand the basis of financial forecasts and their reliability, or perceived reliability. Okay, so that's the income approach. On the market approach, what we really do is we take a look at market multiples for similar transactions. So we may have publicly traded companies in this industry that trade at 1 times revenue or 5 times EBITDA. Okay, and we have typically looked at the market multiples for those in that industry, and then apply maybe some adjustments to the multiples if your company's smaller or more risky. But we want to basically use those multiples and apply them to your company's metrics. So if it's 1 times revenue and you have 5 million revenue, we might say your value is $5 million, simply based on the market multiple. Well, in many instances, that market multiple applied to your last year's financials, if your last year was 2019, may be completely meaningless. Right. Moreover, if the multiple itself came from old transactions, let's say of privately traded companies, your industry may not be trading at 1 times revenue anymore. And so there's a lot of detailed analysis now that goes into market multiples and their application in the COVID world. And there are a number of people out there who question whether or not it can reasonably be applied at all in this type of environment, particularly for the private transaction market multiples. Now, the publicly traded companies may or may not be indicative of your company. And what we've really seen is a bifurcation of the impact of COVID on the public sector versus Main Street. If public companies are able to weather the storm, either because they have access to the debt capital markets or raising equity capital to survive the storm, their smaller business counterparts, even in the same industry, simply may not have that access, and they may not be able to weather the storm. So there can be some very, very severe differentials now in market multiples for public companies versus private companies. Okay.
Well,
The third,
just, as
yeah,
you're talking, what's interesting is it's kind of like, so here you are, I'm going to call you a content expert or an expert of a particular field. And you kind of, and I'm not saying this is you, but you kind of go on all the old principles, and you become really comfortable with, how the market works and how you value a company. And then all of a sudden COVID comes. And basically folks like you have to kind of throw all that out and not reinvent, but reconfigure how you view the market, right? And how those dynamics have changed. So it must be fascinating for you and interesting, because it can't be boring, right? So
it's certainly
got to be,
Yeah.
the ground is shifted under you and under the things that you do, as well your clients, obviously. And is that stimulating for you? Is that created new juice for you, so to speak?
It has, to a degree. And of course, I've always loved business valuation and data analytics and the type of work I do. It does make it enjoying. But one thing that I think is kind of interesting is I might take a little bit issue with the way you characterized it. Business valuation at its root has always been a forward-looking exercise. It's the value of a business today has always been the present value of future expectations, like we discussed in the discounted cash flow method. We simply use the capitalization of benefits method because it presumes future cash flows are going to be relatively in line with historic performance, right? It's sort of what you can call it a shortcut to a DCF if you want. In fact, mathematically, that's exactly what it is. So the exercise itself of thinking about what is the future cash flow generating capacity of this business, that has not changed. It's just become much more complicated because it's very difficult to project or predict how COVID is necessarily going to impact one business or one industry over the other right now.
So the variables that go into that formula are much more nebulous at this point. The formulas are basically the same. It's just, what are we inputting? I mean, what's the information that's going to be inputted that's going to be help us accurately forecast, so to speak. So
that's right. And in the real M&A world, of course, risk is uncertainty. Risk drives down value by definition. And anytime there's uncertainty, i.e. more risk, then valuation is going to be suppressed. So that the real trick to enhancing that value of that business is to reduce the uncertainty in any way you can. And in the world of COVID, that may take on different meanings. That may mean, in the case of a restaurant, doing curbside pickup, right? That may mean developing an app where you have traditionally sold your service in person. Maybe now you need to shift to a more online presence and be able to drive your sales and marketing through online presences. So any way you can reduce that risk and show the buyers out there that you have reduced the risk, you can increase your value.